Well, here to diagnose Goldie and evaluate and counsel is Gary Shilling, president of A. Gary Shilling and Company, Diane Swank, chief economist and managing director at Mesereau Financial, Don Luskin, chief investment officer at Trend Macro. I want to get to the economy in a minute, but Don Luskin, let me go right to you on what is becoming a very hot story, and that is the New Year rally in gold, which really began last fall. It's still below its peaks of over a year ago, but it's up $100 in the last bunch of months. Don, what's happening here?
Larry, I am so glad to hear you admit it. You have been so complacent about inflation. This is exactly what I've been warning about. That's what this is about. The gold rally is about the resurgence of inflation concerns because the Fed continues to signal that it's going to stay on hold as far as the eye can see. It's not just gold. We're seeing a declining dollar. We're seeing the tip spread come back to life. We've seen oil rally strongly off its lows of 2 weeks ago. All of the inflation indicators are coming back. It's a real risk. It's unfinished business for the Fed.
Gary Shilling, you couldn't find any inflation in the GDP report yesterday.
You couldn't. Or in the personal spending report
you couldn't
today.
find any. In fact, let me just read you. PCE deflator, 0.7% last 3 months at an annual rate. The core deflator, only 1.7% last 3 months at an annual rate. Don Luskin says higher gold equals accelerating inflation. Do you agree?
No, gold is pushed around by a lot of things, whether the central banks are buying or selling. IMF just said they're going to sell, but not for 20 years. What the Chinese peasants do with their money, what the gold bugs do. I mean, it's got so many forces that it's only when one of them dominates, like in the last 70s, when you went to $800 on gold, that it really has won. But this is random noise for all intents and purposes, and who knows what the real meaning is.
Now, I know, Don Luskin, you're not going to blame the rise in gold on the rise in oil, but the chart kind of suggests that. Now, maybe there's a temporary inflation influence, but you seem to be alone on this panel regarding the inflation signal of gold.
Well, that's just where I like to be. Nobody's ever made money in Wall Street by going along with the consensus, Larry. But it's not that gold causes oil.
On.
This is not consensus.
Come on.
It's not that gold causes oil to move. It's not that oil causes gold to move. It's that the Fed causes the value of the dollar to fall, which makes the dollar price of oil go up. It makes the dollar price of gold go up. It makes the dollar price of the CPI go up. That is the real definition of inflation. It is everywhere and always a monetary phenomenon. It shows up first in gold. It shows up second in oil. And the signals are loud and clear if you just have your ears open and will listen.
Hey, wait a minute. You look at the dollar against the yen. It's been very strong lately. Yeah, against the euro. No, but this is a very mixed bag. I mean, to say that you have a very weak dollar now is ridiculous. That's just not what the facts show you.
Well, the facts do show you that the trade-weighted dollar calculated by the Fed is about 15% below its 10-year moving average, and that's just a fact. Look it up on the web, Gary.
But that's not new, Don. I mean,
No,
the thing
it's not.
is,
It's been around for quite a while.
Yeah, I mean, and actually, the dollar has stabilized in the last. It's over a year that actually it hasn't. I think going back to late 2004,
It's several years appreciation of the dollar, and it has helped on exports. But on imports, what we've seen is we don't tend to buy things in the trade-weighted dollar on the import side. We buy them from places like China, whiwhich thankfully give us very cheap goods. So that's kept inflation
none
in
of that
check.
is the point. The point is that if inflation is a monetary phenomenon, that means that that the definition of it is a degradation in the purchasing power of the dollar, which shows up in everything for which the dollar exchanges.
It could be showing up in asset prices instead of consumer prices.
If you say inflation is a monetary phenomenon, then you say those idiots at the Federal Reserve between 1941 and 1945 didn't know what they were doing. They humped the money supply and created all that inflation. Well, that's nonsense. They were financing the war. They were just the handmaidens.
Well, wait, I have to defend
policy.
Brother Luskin. Inflation is a monetary phenomenon. Too much money chasing too few goods. The question is,
what lies behind it?
The question is how one measures excess money or excess liquidity.
Exactly.
And also where the inflation
market,
is.
The bond market is not telling you that, although there's a slight little puff of inflation creeping in the bonds in the last week or two, but not much. But Don is saying the gold market is still, old-fashioned as it is, a measure of inflationary money, Diane. So you're not going to, you say, no, absolutely wrong. How much gold do you have on your person right today?
Actually, today I have none on.
None? You always come equipped with gold rings and jewelry, and you always flash it.
I have a silver ring on that has a clear heart on it because I had a heart surgery and had my hole closed in my heart, so my heart's whole again.
Oh, well, we are glad
How about that?
We are glad you are healthy on that point. Here we go. Don Luskin, we have seen some weakness in manufacturing. There's no two ways about it. And I noticed in the GDP report yesterday, business capital investment spending was down for the second quarter, and it's actually 2 quarters out of 3 that CapEx has been down. So that doesn't sound like a lot of overheating.
Yeah, there's no overheating at all. We just have a good, strong, sustainable recovery. And it's all the more remarkable because we've had this auto slowdown and we've had this housing slowdown that all the perma bears were so sure was going to infect the rest of the economy. Quite the contrary. You know the numbers. You take housing out, you take autos out, we had a 6% quarter. There was no infection at all from those encapsulated problem areas into the economy at large.
You can always throw out
zero,
enough.
zip, nada.
But I want to come back to Don Luskin. Don, let me play this out. If your view is correct, I mean, every 3 or 6 months, I love to revisit the gold story and titillate everybody. It gets everybody so excited. So you're saying, okay, gold is signaling higher inflation. Higher inflation is going to signal higher bond rates. Ultimately, the Fed's going to be raising their rates. So you must be out of the closet with Brother Ritholtz. You must be a seller of stocks because that's going to wreak havoc on the stock market.
Well, it's all a question of timing. I'm going to be a seller of stocks, but I'm not going to do it today because the Fed is on hold as far as the eye can see. They've just decided to become oblivious to all the evidence of inflation.
But
wouldn't
you want to get out ahead of the curve on this sale? I mean, everybody's bullish. It's too easy to be bullish. I mean, I'm bullish. Everyone's bullish.
Well, fair enough, but I think it's got to. Timing is everything, right? That's the game we're all in. That's why you run this show every day instead of every month. and I think that we can play this a little bit closer to the bone. I think we can wait maybe another month, another 6 weeks, another 2 months, and we'll call the top. But we're not there yet.
Don Luskin, I got to ask you, supply sider to supply sider. One of the great stories of the greatest story never told is low marginal tax rates, particularly on investment, which is driving this economy forward, to which we must give Mr. Bush a lot of credit he never seems to get. So my question to you, Don, is if low tax rates are driving economic growth, creating more goods and services, then doesn't that absorb the existing money supply, and therefore isn't growth consistent with low rather than high inflation?
There's no relationship between growth and inflation at all. Okay? What drives inflation is the Fed. For any given level of growth, high level or low level, there's an appropriate amount of money.
You're saying there's no linkage? If I have more goods and services, I mean, I think history shows, this is Art Laffer, Victor Canto, a lot of people, including myself, the more goods usually the high inflation comes at the low growth, the low inflation comes at the high growth. You got it kicking on all gears here.
It's hard to say which way the lines of causation run, isn't it? I would argue that when you have low, stable inflation, that actually enables growth because it enables the risk-taking that makes growth possible. But my point is, whether you're in a high-growth environment or a low-growth environment, the Fed can still blow it by printing the wrong amount of money. So it's not sufficient to just look at the amount of growth. You have to ask yourself, what is the Fed doing against that background?
Where's the Fed funds rate? Where's the Fed funds rate going to be at year-end, Don, in your scenario?
At least 6.
At least 6. It's today at 5 1/4.